Have you ever felt a quiet tremor of uncertainty standing at the edge of your financial aspirations? A persistent whisper questioning if all the maps are truly charting the path *for you, or if some are designed with hidden detours. This intuitive nudge, sensing that not every piece of financial counsel aligns perfectly with your deepest desires for wealth and independence, is not a flaw. It is a profound insight, a guardian within you, urging a clearer, unvarnished truth. Many of you carry the weight of opaque advice, the frustration of market noise, and the gnawing fear of costly missteps when the genuine mechanisms of wealth creation remain elusive. You yearn for clarity, for a framework that builds something lasting, a legacy reflecting your wisdom. This journey can feel solitary, laden with anxiety about the future, or the struggle to translate complex theories into actionable strategies. We welcome that pain, that quiet ache for understanding, for it is the fertile ground from which true insight blossoms. Today, we journey beyond the visible horizon of conventional financial advice into the heart of your investment relationships. We will uncover a fundamental truth, a secret your broker might prefer remains just beyond your full grasp. This isn't about judgment, it's about illumination, revealing a powerful lever you already possess. It's a key to unlock independent, data-driven decision-making, transforming you from a passive recipient into a confident architect of your financial future. We are not just investing, we are understanding the why behind every decision, moving with intention towards sustainable wealth. Are you ready to look beyond the headlines and truly understand what's really driving your investments? To grasp this, we must confront a silent tension, a fundamental disconnect often overlooked. Your broker operates under a business model that, by its very design, can subtly conflict with your long-term wealth compounding. Benjamin Graham, the patriarch of value investing, understood this implicitly. He taught us to view ourselves as business owners, not mere market timers. A business owner seeks enduring value, patient growth, and a margin of safety, while market activity, driven by frequent transactions, often benefits intermediaries more than the principal. This isn't an indictment of individuals, but an illumination of systemic incentives. When commissions or transaction volumes drive revenue, the quiet, patient accumulation of wealth, the compounding magic true investors revere, can be inadvertently sidelined. It's a subtle form of information asymmetry, where the full alignment of strategies with their incentives versus yours might not be fully transparent. This understanding, this critical inquiry into the very structure of your financial relationships, is the secret leverage we speak of. It transforms the feeling of being outmaneuvered into a powerful starting point for reclaiming your decision-making autonomy. This allows you to challenge the consensus and find your true market edge, building sustainable wealth with profound, data-driven truth. Let us now turn our gaze to a silent, insidious force that often devours your wealth without a trace: the invisible tax of brokerage fee structures. Many of us have been lulled into a sense of security by the alluring promise of free trades, a myth that, while convenient, fosters a deep, unconscious cognitive bias. We believe zero commission means zero cost, creating a void in our trust for mainstream financial narratives. This silent fear of financial loss, rooted in unseen costs, can subtly erode the very foundation of your compounding power. This belief in free is a dangerous confirmation bias, appearing as prudence, yet often masking inadequate due diligence. Brokers, while seemingly offering a no-cost service, often profit handsomely from mechanisms like payment for order flow, spread markups, and even soft dollars, indirect costs that chip away at your returns far more subtly than any explicit commission ever could. These are not mere technicalities, they are genuine underlying mechanisms, hidden truths that distinguish effective strategies from common misconceptions. The counterintuitive truth is that these cheap or free brokerage services often come with hidden costs designed to extract value from your portfolio, directly challenging the notion of a broker as a neutral facilitator. This shatters the expectation of an unbiased guide, revealing a landscape where true financial mastery demands a deeper gaze. To navigate this broker's labyrinth, a complex, seemingly impenetrable fee structure designed to obscure your path to ultimate investor self-sovereignty, we offer a three-step forensic accounting technique. First, carefully analyze your trade confirmations, not just for explicit fees, but for subtle spread discrepancies that indicate the true cost of your transaction. Second, demand full fee disclosures that go beyond the headline promises, delving into every potential charge, direct or indirect. Third, compare your net performance against a true zero-cost benchmark, such as a direct indexed fund, to discern the real impact of these hidden costs on your portfolio's growth. Mastering this labyrinth transforms wounded financial confidence into strategic empowerment, marking the first step towards financial emancipation. By understanding these subtle drains, you are not just saving money, you are reclaiming your power to build sustainable wealth, truly informed and truly independent. Don't just invest, understand the why behind every decision. Now, let us delve into another subtle narrative that can mask underperformance. The conventional wisdom of diversification. Many of you have felt a philosophical wound, questioning the fundamental fairness of market mechanisms when generic diversification advice consistently leads to merely mediocre returns. You desire to understand how to build sustainable wealth free from conventional biases, yet find yourself caught in a strategy that feels like a safety net, but often ensnares rather than liberates. The myth that diversification alone guarantees safety, or that past performance predicts future returns, is a common distortion. This often promotes over-diversification, a phenomenon Warren Buffett famously terms diversification. It's a psychological trap where owning a little bit of everything dilutes your conviction, masking truly strong performers within a sea of average or even weak assets. The shattered expectation here is that true portfolio resilience isn't about broad exposure for a broker's ease, but about concentrated, intelligent bets. It's about fundamentally sound, undervalued assets balanced with rigorous risk management, challenging the notion that broad exposure automatically equals optimal safety. Consider the wisdom of Warren Buffett's capital allocation philosophy, a focus on a few truly excellent businesses understood deeply rather than a sprawling, unfocused collection. This practical transformation involves rigorous due diligence to identify enduring economic moats, those competitive advantages that protect a business's long-term profitability, and then sizing positions based on conviction rather than arbitrary percentages. This approach reveals hidden truths about portfolio construction, allowing you to move beyond superficial analysis and connect complex theory to practical, profitable application. Imagine your portfolio not as a vast, untended field, but as a carefully cultivated garden. A broker might encourage planting every seed, hoping some grow, which can feel overwhelming and lead to a sense of inadequacy when faced with complex financial jargon. A strategic investor, however, cultivates only the most promising plants, pruning the weak, ensuring optimal growth in fertile ground. This transforms a feeling of following generic advice into leading your own wealth creation, fostering a questioning mindset that empowers independent, data-driven financial decisions. Is your diversified portfolio truly diversified, or is it merely diluted? Let us now confront the subtle illusion of guidance and how behavioral biases are often exploited within the traditional advisory model. Many of you have felt the silent fear of financial loss stemming from acting on emotionally charged advice, alongside a growing distrust of financial authority when advisors seem to profit from your mistakes. You desire to confidently navigate opaque markets by understanding not just the numbers, but your own psychology. This pain, this inner conflict, is a vital signal urging you to seek deeper truth. One pervasive error, often mistaken for decisiveness, is anchoring bias, the tendency to rely too heavily on an initial piece of information, even when it's irrelevant. Brokers can subtly anchor clients to previous wins or market highs, encouraging the holding onto losing positions too long or chasing fads, often enabling product churn that benefits the broker, not your long-term wealth. This hides a fundamental truth. Ignoring contradictory evidence is not prudence, it's a cognitive trap. The shattered expectation here is profound. Your broker is often not a neutral therapist for your investment emotions. They are frequently incentivized to leverage your cognitive biases. This counterintuitive truth reveals how powerful forces like FOMO, the fear of missing out, and loss aversion are subtly weaponized to generate transactions. It's a mechanism that, while not always malicious, fundamentally misaligns with your goal of sustainable wealth accumulation. To discern genuine advice from bias exploitation, we can adopt a three-step behavioral finance technique. First, identify your own core biases, perhaps loss aversion or recency bias, by reflecting on past decisions. Second, demand a clear, data-backed rationale for every recommendation, forcing a deeper understanding beyond superficial narratives. Third, practice a pre-mortem analysis on your own decisions before making a significant investment. Imagine it has failed in the future, and then work backward to identify potential causes. This forces a critical look at potential failures before acting, cultivating intellectual discomfort that leads to better choices. Consider how the pursuit of quick market wins can release dopamine, offering a fleeting sense of reward that might hinder your empowered, data-driven decision-making. The broker, by encouraging activity, often provides this hit, overriding the calming presence of serotonin, your sense of control, and the intellectual discomfort of cortisol, which drives deep analysis. This subtle interplay can lead to impulsive decisions rather than strategic implementation. Are you truly making informed decisions, or are your emotions being gently steered? Let us now consider the long-term trap, a subtle snare where broker incentives can inadvertently short-circuit your compounding power. Many of you feel overwhelmed by information overload, struggling to synthesize market narratives into clear, actionable insights, especially regarding the true mechanisms of compounding. This often leaves you feeling inadequate, doubting your ability to make truly informed, independent investment decisions for long-term wealth, a painful uncertainty we recognize and address. There are pervasive myths, such as higher risk always equates to higher returns, or financial news directly translates to actionable investment insights. These distortions often push investors towards active, high-fee products or frequent trading, directly contradicting the quiet, profound power of long-term compounding. This is where the shattered expectation lies. The true long-term impact of seemingly small financial habits like unnecessary trading or accepting high expense ratios is vastly underestimated. Brokers benefit from these small leaks, while your compounding suffers dramatically, often without you even realizing the extent of the erosion. Consider the story of John Bogle, the visionary pioneer of index investing. His journey reveals the critical importance of independent thought and data-driven analysis over fleeting market sentiment. Bogle's approach emphasized low-cost, broad market indexing, a strategy that, while generating minimal fees for brokers, maximizes compounding for investors. He understood that the true secret to wealth accumulation wasn't in chasing performance, but in minimizing costs and staying the course, a testament to the power of patient, disciplined investing. Imagine your accumulated wealth as a snowball, growing larger and more powerful with each roll down a long hill. Unnecessary fees and frequent trading, however, act like holes in a broker's sieve, preventing the snow from accumulating and diminishing the snowball's potential. This analogy empowers you to protect your snowball from the pervasive sieve of conventional brokerage incentives. By understanding these subtle forces, you are not just making smart financial choices, you are fostering a questioning mindset that empowers you to make independent, data-driven financial decisions, ensuring your wealth grows unhindered. Are you letting your snowball melt away, or are you safeguarding its compounding magic? Let us now pull back the veil from the market analyst and truly understand why their forecasts often serve the broker's agenda, not your portfolio's growth. Many of you have experienced a loss of faith in conventional financial advice, perhaps due to past failures or the sheer volume of conflicting information. This leaves a void in trust for mainstream financial media and a deep yearning for sharpened critical thinking skills and truly independent, informed decisions. This frustration is a powerful catalyst for seeking genuine understanding. A common distortion revolves around economic indicators and the seductive law of market timing. Brokers often amplify analyst forecasts, not for their predictive accuracy, but to drive trading volume, capitalizing on the fear of missing out or the pervasive anxiety of market downturns. This happens regardless of whether the forecast holds any actual predictive power. This shatters the expectation that expert market analyzers are objective predictions for your asterisk benefit. Instead, they are often tools to generate trading activity, support underwriting deals, or provide cover for institutional clients, revealing systemic risks often overlooked by superficial analysis. To navigate this landscape, we can employ a three-step critical thinking technique inspired by Benjamin Graham's timeless Mr. Market analogy. First, always question the source's incentives. Who truly benefits from this forecast or recommendation? Second, evaluate the underlying data, not just the compelling narrative. Is the information verifiable, robust, and free from emotional bias? Third, treat market forecasts as mere entertainment, not instruction. Remember, Mr. Market is there to serve you with prices, not to guide your decisions with his emotional whims. Society has, perhaps inadvertently, distorted the image of the independent, data-driven investor by promoting reliance on these expert predictions. This is a fatal mistake for those seeking actionable, rigorously data-backed financial strategies. Relying on such forecasts is like trying to build your wealth upon a financial forecast written in sand on a windy beach, ephemeral and utterly unreliable. Instead, your foundation must be built on solid ground, your own informed research, your understanding of true value, and a skeptical mindset towards market noise. Challenge the consensus. Find your edge. We have journeyed together through the often opaque landscape of financial markets, uncovering truths that, while uncomfortable, are profoundly liberating. The secret your broker might not explicitly share, but implicitly operates by, is this: their business model is often diametrically opposed to your long-term wealth compounding. This understanding is not a cause for cynicism, but a bedrock for true empowerment. It is Benjamin Graham's margin of safety applied not just to individual stocks, but to your entire financial relationship, ensuring your interests are protected by a wide moat of knowledge and independent action. We have moved from a place of feeling inadequate and distrustful to one of empowerment and discernment. We dissected the invisible tax of hidden fees, challenging the myth of free trades that silently devour your returns. We questioned generic diversification, revealing how diversification can mask underperformance, urging you to cultivate a focused garden of quality assets. We exposed how behavioral biases are exploited, turning your natural human tendencies into transactional opportunities for others. And finally, we unmasked the true purpose of market analyst forecasts, showing them as tools for activity, not objective guidance. Each step has been an act of reclaiming your financial sovereignty. Now, the path forward is clear, though it demands diligence and courage. Your actionable next steps are not about abandoning the system entirely, but about navigating it with sharpened awareness. Develop a rigorous, data-driven framework for evaluating every financial product and service presented to you. This means looking beyond the headlines, demanding transparency, and understanding the why behind every decision. Cultivate independent thought, trusting your own research and critical analysis more than the fleeting whispers of market sentiment. This intellectual curiosity is your greatest asset. Remember the profound wisdom of Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. This maxim, often quoted, is only truly possible when you understand the hidden mechanisms, the genuine underlying truths, not just the surface noise. It requires an intimacy with data-driven truth, a commitment to sustainable wealth creation, and a dedication to informed decision-making. Your journey to financial independence is not about finding a magic formula, but about mastering yourself and deeply understanding the true workings of market efficiency. This is not the end of a lesson, but the beginning of a profound practice. What will you choose to build on this solid ground of understanding?